It's Friday, November 18th, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and I'm joined once again by Group Chief Economist Neil Shearing. Hi, Neil.
Hi, David.
You're just back from a week of client meetings in New York and Toronto. I wondered if you could start by giving us a flavour of your discussions. What are on their minds over the Atlantic?
Well, as you might expect, it's the same things that are interesting clients everywhere, which is inflation, monetary policy, and the extent to which central banks are going to have to drive economies into recession in order to squeeze inflation out of the system. I think if you take a step back, there was general sense that economists are kind of dancing around this idea that there might be a recession next year in some economies. I've seen some people in their 23 outlook saying 30% chance, 40% chance of a recession. We've obviously put our necks out and said, actually, there will be a recession in 2023, a mild one in the US and slightly deeper ones in Europe. So I think sense that we kind of stuck our necks out a bit on that, but also tempered with better news on inflation, particularly in the US. So our inflation forecasts are showing that inflation in the US we expect to come down a bit further and a bit faster than most people, including the Fed.
So a mixed set of data, but I guess the point is it's not uniformly gloomy. Just picking up on one of them, the Eurozone industrial production number came in quite strong, but it does seem as though there were some distortions there with regard to Ireland's contribution. So to what extent should we take that data at face value? Is activity in the Eurozone as robust as it seems, and how sustainable is it?
I think there's a general point to be made here, which is that the economic activity data, the hard economic activity data, have not deteriorated to the same extent anywhere that the business surveys have suggested that they might. So we've seen business surveys in the Eurozone, and for that matter, the US as well, kind of weakened quite considerably over the past couple of months. It's not yet been reflected in the hard activity data. So data over the last week or so have perhaps been on the whole, a bit stronger than we'd expected, but that's particularly true in Europe. And you mentioned the Eurozone IP data. Digging down, and Andrew Kenningham, our chief Europe economist, has done some work looking at this and published some notes last week. There does seem to be a few, what you might say, one-offs and peculiarities. Ireland's contribution to Eurozone GDP is one, but there's also, I think, a sense that the German car industry as well is a bit of a rebound in production there as some supply constraints are working through. Obviously, we've seen that happen in the US. It's happening later in Europe. But of course, once those supply constraints have and the supply shortages starts to ease and they're working their way through, it's not going to be a kind of lasting recovery, I don't think.
You also mentioned the inflation numbers. We had another hot print for UK CPI this week, and the Eurozone inflation report was also above expectations. Our Europe team had a report out this week talking about how core inflation there is going to remain high into next year. And that's quite a contrast with the message that our US team had out earlier this month. And it's a question that's come up in a client briefing earlier this week, where the client was asking, the extent to which inflationary paths are diverging, and what's driving Eurozone inflation pressures that perhaps aren't being seen in the US.
Yeah, you're right. It's an interesting divergence in the numbers. I think two things are happening with inflation globally. One is that the kind of pandemic effects, if you like, are rolling out off at slightly different times. So we're already seeing signs of product shortages ease considerably in the US and slightly later in the Eurozone, but we're getting there. So I think that over the next 6-12 months, we're going to see a big drop in core goods inflation and, for that matter, food and energy inflation across all economies. The other part of the puzzle, and the second part, is what's happening on the services side. And that, of course, links more closely to what's happening with general demand pressures in economies and the state of labour markets. Now, we have our own proprietary indicators looking at labour markets, Slack. You can find those on the platform. But the short message is that there is some signs finally that labour markets might be starting to cool in the US, but we're not getting that evidence of cooling in the Eurozone yet. Now, I suspect we'll get there, but it's going to take the ECB has a bit more work to do to take some of the heat out of the labour market. So, I mean, if you think about it, there's been a consistent theme here, which is that the US experienced a faster recovery from the pandemic. The US experienced an earlier recovery from the pandemic. It experienced an earlier surge in inflation. It's seen inflation turn before the Eurozone. So the US has been kind of one or two steps ahead of the Eurozone throughout this period. And I think it's going to remain the case that the core inflation will turn in the US before it starts to turn in the Eurozone.
But For all that, it does seem like central bankers are all still singing from the same hymn sheet. We had hawkish comments from Lagarde this morning, that's Friday morning in the UK, and James Bullard from the St. Louis Fed talking about his interpretation of sufficiently restrictive policy rates, saying they're somewhere between 5 and 7%, which is considerably higher than where they are now, and indeed higher than the peak that we're forecasting. So it doesn't sound like central bankers are willing to move too far away from their current stance, despite the market cheering from the CPI report in the US last week.
No, and I think, to be fair, we wouldn't have expected them to have done that on the basis of 1 month's data either. There's an interesting note that Jenny McEwen, our chief global economist, put out the week before last, looking at central bank communications at the point that they had enacted the final hike in the cycle, or the final move in the cycle. And there's no evidence that they're kind of signaling at the point at which they actually were done, that they're done at that time. So I don't think this time should necessarily be any difference. I don't think we should necessarily expect central banks to be sending very strong signals about turning points in the cycle, certainly not on the basis of 1 month's data. You're right, the policymakers, particularly in the US, have been pushing back against this idea increasingly in the bond markets, now priced in that they're close to being done and there'll be a turn next year. We still think that's the case. We still think by the first quarter of next year the Fed will be done, and that by the end of the year it will be cutting. But you're right, there's no sense from policymakers that they're entertaining that just yet.
So you're just back from North America from this client trip. I remember the last time you went on a client trip, that was Singapore early October. You went to talk, amongst other things, about global fracturing, but I believe you wound up discussing whether the UK government had lost its mind. That was at the height of the Truss Kwarteng market mayhem. We've now had the autumn statement from Jeremy Hunt, and the markets seem to have taken what he said in their stride. So has the UK government made its amends with the so-called bond vigilantes?
It seems that way. But I think one of the lessons from the UK debacle for other countries, and I'll write about this in my note on Monday, is the old adage about credibility being difficult to win but easy to lose, particularly in a world of rising interest rates. There's much less room for fiscal error. So it's been a pretty costly exercise for the UK government, this. Now, that the budget that we had, or the autumn statement that we had this week, was a difficult balancing act, both politically and economically. Hunt had to win back some credibility in the markets, but also he was successfully, I think, managed to pull the trick off where a lot of the squeeze is kind of backloaded. It's not going to come until after the next general election. It's all in the kind of back end of the forecast, 25, 26, 27. So he meets his fiscal rules without necessarily tightening fiscal policy at the point that the UK economy is now in recession. So I think a difficult balancing act that he managed to pull off, but it's going to be a pretty grim few years in the UK economy. And there's a lesson here for others, which is, as I say, in a world of higher interest rates, there's much less room for fiscal error. It's much easier to lose credibility with the markets, and it's quite difficult to win that back.
We've got Thanksgiving in the coming week. It's likely to be a quieter one for markets. What's on your radar screens?
Well, just moving on from the point about the UK's autumn statement and the fiscal debacle here, we're going to get news from Italy on the first budget, the new Italian government. So I think that's going to be something that we should pay very close attention to. Now, as far as we can tell, what's been trailed in the media, it looks like there will be a bit of a fiscal loosening, but it will be temporary, time limited, and around providing energy support to households. Actually, the medium-term fiscal plans of this Italian government still look reasonably sensible and in line with the EU's budgetary framework. But that, I think, will be a key event next week, something in light of what's happened here in the UK that the markets should be paying very close attention to.
Now, this year's dollar rally is one we'll be telling our grandchildren about, but it has come off the boil over the last few weeks. Is it just a wobble, or does it point to a more fundamental shift in currency markets? Here's a conversation from earlier Friday between Jonas Golterman and Jonathan Peterson from our FX team about the dollar outlook. And it starts with Jonathan asking Jonas about whether we're past peak dollar strength.
All right, so we're just about to close out another week in markets here. And even though it has been very volatile in markets over the past couple of days, the dollar is still quite a ways off its peak. We've got a couple of questions from clients, and it's definitely something that's been covered quite a lot in the media. And that's kind of the key question of, what's going on, and do we think this is the peak in the dollar?
Yeah, that's right. It's been a pretty big move this past two weeks, really, since this, the dollar did peak back in late September and is down about 6-7% since then. Most of that in the past couple of weeks. And I think I think we've identified 3 reasons that might explain it. And I'll start with sort of going from what I think is the least important to the most important. The first one might be what's going on in Ukraine. You've seen the reconquest of one of the major cities there by the Ukrainian armed forces. And I think there's a perception that no one knows how the war is going to end, but that this is taking us one step closer to the end game, whatever the end game looks like. And that in itself is a positive for markets, and because an end to the war would remove a big tail risk that's been hanging over us since that all started, really since the start of the year. And that would be a positive for especially for European currencies, because they're the ones that have been most affected. Now, obviously, we don't know what's going to happen with the war. I'm not going to sit here and pretend that we have any kind of special insight on that front, but I do think that's been a factor. The second one, sort of moving up the importance scale here, is China, and this talk about ending zero COVID, and also the various support measures that they put in place for stimulating the economy, in particular the property sector that's been so weak for quite a while now. And obviously, a reacceleration or an improvement of the economic outlook in China would be a pretty big positive for the global economy, especially for commodities and sort of the currencies of commodity producers and other economies that trade a lot with China. So that's been a big move we've seen across equity markets. We've seen bond yields rise in China and in currencies as well. The renminbi had a couple of really big up days off the back of that. And that, I mean, that makes a certain amount of sense, but I think we're a bit skeptical that that's going to last. Mark and Julian talked about this topic on the podcast last week, and I think, basically arguing that zero COVID is going to go on for quite a while yet, because the underlying problem they have with low vaccination rates, and especially among the elderly, that hasn't changed, and the reaction function from the government I don't think has changed either. So I think the optimism on that front probably is a bit premature. And finally, the big one that really moved the dial for the dollar is the US CPI number we got last week, and this renewed hope of a pivot from the Fed towards slowing down the rate hikes, eventually ending rate hikes, and then shifting towards policy easing. Now, the CPI data that day, we saw one of the biggest single day moves in the dollar over the past few years. It was down more than 2%. If you look at the DXY index, you're looking at the historical record that mainly happens when the Fed is already easing policy and doing liquidity support in moments of crisis. So 3 of the 5 episodes in the past 25 years, that was LTCM, 9/11, and several times during the global financial crisis. So that gives you a sense of just how extreme that move was. But it also kind of points to that in that context it doesn't make an awful lot of sense. Right? The Fed is not easing yet. They're not even close. This isn't over. It's one data point, and we've seen a number of Fed speakers make exactly that point. You had Bullard yesterday, Waller earlier in the week, Kashkari, George, sort of pretty unison in saying, this. You've overreacted, guys. So I think that's what's been going on, and I think for a lot of for all 3 of those things, I think you were a bit skeptical that it's really more than a short-term reversal of the overall upward trend in the dollar.
Yeah, absolutely. And to some extent, I mean, it makes sense, right? If you look at the graph of the DXY, it's been almost a parabolic rise over the past year or so. Given how sharp of a rise it was, just on simple metrics like rate of change, and with investor positioning being quite heavily skewed towards the dollar, it's not so surprising that we get a period of consolidation here. If anything, it would be a bit strange if it was just a one-way street. But I think part of the reason why it's been such a uninterrupted rally has been, the main factor you've mentioned here, and what people are calling into question is the hawkish Fed and rise in bond yields over and above, in the US, over and above what we see elsewhere in the world. And that's highlighted, I guess, a dynamic we've often referred to, which, we tend to use the dollar smile framework, where the dollar tends to outperform well, either in circumstances where the US is leading a global growth phase or global recovery phase, or when there's concerns about global growth and you start to see financial conditions tighten, global trade slow, and the dollar benefits from safe haven demand. And we've seen at different points in the year and, really over the past year or so, obviously the hawkish Fed in the US, just broad outperformance, both economically, higher interest rates, et cetera. That's really been the main factor. That was, I think, boosted by the terms of trade shock earlier this year. And that's really been the key driver. So it makes sense that people kind of call into question, oh, maybe this is it. Maybe this is the turning point as the Fed, moves past peak hawkishness. But like you said, we're probably not quite there yet. And I think the other important thing to point out is that, well, what's the alternative? What's going to make the Fed ultimately go from peak hawkishness? It's not only, inflation coming down, but as they've noted, a shift down, to below trend growth for some period of time. And even, they're becoming, I think, a little bit more vocal about risking an outright recession and being comfortable with that. And again, in that case, that's generally a very dollar positive environment. So we could move from a world where it's a sort of rates driven dollar rally to a risk driven dollar rally that's underpinned mostly by safe haven demand. And I think if you look back at past cycles, notably 2001, you saw the 10-year yield peak, 2-year yield peak, and interest rate differentials peak well ahead of the dollar's peak. And that had a lot to do with safe haven demand and continued flows into the US dollar. So definitely seems like as we take a step back, key drivers remain in place. And even as we transition to a world where there's growing concern about global recession, that's also dollar positive. So it's like we've sometimes said, heads I win, tails you lose. The dollar, just given the sort of unique global backdrop that we have at the moment with the Fed going full speed ahead, but increasing signs of gloomy growth outlook. So
Yeah, I think that's right. I mean, that's what our base case for the dollar is built off, this idea that, we're heading into a global recession. It's already started in some economies. China's been weak for quite a while now. Here in the UK, we have negative GDP growth in Q3, and then that probably was the start of a recession here. And Europe is headed the same way, probably the US as well next year, right? So, we're forecasting a recession that I think, it's definitely being talked about out there, and to some extent, at various points this year, you could say, markets are moving towards pricing a recession, but the realization that we've seen over the past couple of weeks with, equities rallying, bond yields coming down, credit spreads coming down, that's not consistent with market participants pricing in a recession yet. And I think when that happens, I think you're right, we're going to see a significant rebound in the dollar off of the back of that kind of safe haven dynamic. So that's a key part of our forecast. I mean, just in terms of numbers, the DXY is about 106 this morning, 106, 107, and we're forecasting that to reach close to 120 in the first half of next year. So another 10% or so, I would say, from here. It's a pretty substantial move, certainly given how strong the dollar has been already over the past couple of years. Now, the past couple of weeks, though, it's probably the biggest challenge that we've seen to that bullish dollar view since that rally started. Early 2021, wasn't it? After the Georgia elections, that you really saw the first turn towards the dollar bull market. Then really sort of gone from strength to strength, especially this year. So it's fair to ask the question, what would make us wrong? What scenario, and what would it take for our forecast to be wrong? What are we most worried about?
Yeah, I would point out two factors in particular. I think for a sustained turn in the dollar, what we'd probably need to see is something like a Goldilocks scenario. Going back to the dollar smile framework, when the dollar tends to do worst, is an environment where global economy is holding up pretty well and other countries are holding up or just growing much faster than the US economy. So that's a scenario in which maybe US economic growth is weaker or something else causes the Feds to pivot much sooner than expected, even as everyone else maintains a fairly hawkish stance and their economies hold up reasonably well. Now, I think for a number of reasons we've mentioned before, we don't really see that being the base case, right? China moving past its zero COVID policy, that's, I think, part of that narrative, and maybe people thinking about echoes of past cycles where the Chinese government stimulated and that ultimately brought the global economic cycle, back into growth mode.
Yeah, China's saving the day. We've seen that
China
a few
saving
times,
the day.
right?
That definitely plays into that possibility that, maybe we do get a Goldilocks scenario. Everybody holds up a lot better in the recession that we're expecting, or maybe there is no global recession, or maybe there's one that maybe countries now are experiencing recessions, but the US is kind of out of sync with that cycle and the rest of the world starts recovering much sooner than the US. There's definitely seems to be a window there. Obviously, it's not our base case, so it's not really the one that we put a whole lot of weight on, but that scenario would have to look something like that. I would say the second factor relates to valuation. We just published our valuations monitor in the past month or so, and it definitely stands out as overvalued across a number of the different metrics that we look at. And that incorporates relative macroeconomic variables like terms of trade, productivity growth. It also looks at simpler measures like long-term yield differentials, mean reversion, and really just across the board, you can see that the dollar is quite overvalued. Now, it did look overvalued earlier this year, but I guess the difference is we've seen a shift in fundamentals in favor of the dollar, notably the terms of trade shock, along with the rise in the dollar. So it was overvalued, but wasn't, really at extreme levels. Now, that's probably not the case, and we don't really see there being much scope for those fundamentals to shift further in favor of the U.S. relative to its other major trading partners. So that all considered, I think yes, the dollar is overvalued, but the macroeconomic scenario where we get the Fed to act in a certain way and other countries ultimately outperforming the U.S. in terms of economic performance and remaining hawkish in the face of slowing growth, that seems to still be quite a narrow window or a low probability scenario, and I think in our estimation.
Yeah, I think that's right. I mean, valuation, we often talk about, you think of it as being a necessary but not sufficient condition for a turn in the dollar or other currencies. So I think you're right. You need not just that condition overvalued dollar. You also need a catalyst that leads to a shift a big shift in the outlook, shift in the factors that have been underpinning the dollar, and you can see why the CPI and the pivot narrative could be such a catalyst, but still seems a bit optimistic to hope for a Goldilocks scenario. Next year, I think we might get there, and hopefully towards the end of next year, 2024, as we see a recovery take hold. But until then, unfortunately, it's going to be more of what we've seen this year. Equity markets under pressure, risk under pressure, economies generally not doing so well, unfortunately. And I guess the other point about valuation is it's a difficult concept. Whether you look at equities or credit or bonds, I think it's particularly difficult with currencies because there's just so many factors that go into it. So, on our models, the dollar looks, and I think we put it like 15-20% overvalued on a trade weighted basis, which is quite a lot. Once you get to 15-20% over what looks like our estimates of fair value, then you got to pay attention to that. But the problem with a lot of these models is they kind of almost assume the mean reversion because historically currencies are strongly mean reverting both over the short term and the medium term. But what they struggle to pick up a big structural shift when things like terms of trade, they take months or even years to play out with those shifts and how it affects the relative prospects of different economies. And I think that the data they started earlier this year, so the data isn't really there yet, and it's hard to make a strong judgment right now. But I think there is a sort of if you think about another scenario where the shift we've seen in energy markets this year proves partly permanent, and Europe and Asia are just sort of permanently worse off because the price of energy, especially natural gas, is going to be substantially higher than it's been over the past decade or two. And the US, which now produces more energy than it consumes, so it's actually exporting this stuff, is going to be the big beneficiary of that, both directly through improvement in their current account in terms of trade, but also because a lot of industries energy intensive industries in particular, are going to want to potentially relocate to the US or expand in the US and not elsewhere. And that could be a kind of structural tailwind for the US over the medium term. And that means that, instead of the overvaluation being resolved by the dollar falling, it could just be that, well, the dollar stays strong or stays around current levels or even higher, and the fundamentals just improve for the US. I don't know. I mean, that's a dangerous narrative to try to spin. That's what people used to say in the 20 years ago, the dot-com boom, that it was some sort of permanent shift in favor of the US. Productivity was going to be permanently higher, and then therefore the dollar should be stronger. And that obviously all came to nothing pretty quickly, and the dollar fell in the noughties. But I don't know. I think it's worth thinking about it, and it's a possibility that a year ago it would have sounded far-fetched. It's still a bit far-fetched, but
yeah.
I think
So
it's
even the
increasingly
longer term,
possible.
Yeah, even the longer term or medium term case for dollar bearishness isn't all that obvious, right? And I think summing it all up, it's really, well, seems like in the near term, the bullish case for the dollar has definitely eroded, but it's not quite clear what the sort of off-ramp is for the dollar, or what it is going to be that takes the dollar much lower from here.
Yeah, I think that's the way to think about it. You need to be pretty optimistic about where the global economy is heading, where various things are going, in order to be a dollar bear at this point. And that's why I think, summing it all up, that's why we're sticking to our current forecast. I mean, we still think the dollar rally has further to go.
And that's it for this episode. You'll find all our work on Eurozone IP, on the autumn statement, the Italian budget, and the dollar outlook on our website, along with everything else you need to know about global macro and markets. That's capitaleconomics.com. But until next time, have a great week.